Hello everyone, welcome to Analog IAS. Today we are going to discuss about non-banking financial company. It is a company registered under Companies Act 1956. It is engaged in the business of loans and advances, acquisition of shares, stocks, bonds, debentures and securities, leasing, hire purchase, insurance and chit businesses. Also, it does not include any institution whose principal business is agriculture activity, industrial activity, purchase or sale of any goods other than securities, providing any services, sale, purchase, construction of immovable property. So, what is principal business? A company should fulfill these two criteria to be registered as NBFC by RBI. They are, it should constitute more than 50% of total assets and its income from financial assets should constitute more than 50% of gross income. Next, as per the regulatory guidelines, only those NBFCs with a minimum net owned fund of 2 crore rupees are allowed to operate. Now let us see what is systematically important NBFC. NBFCs whose asset size is 500 crore rupees or more are considered as systematically important NBFCs. The rationale for such classification is the activities of such NBFCs will have a bearing on the financial stability of overall economy. Now let us see the differences between banks and non-banking financial companies. This is very important. So NBFCs cannot accept demand deposits. NBFCs do not form part of payment and settlement system and cannot issue checks drawn on itself. And the third difference is deposit insurance facility of Deposit Insurance and Credit Guarantee Corporation is not available to the depositors of NBFCs, unlike in case of banks. Recently, NBFCs categorized as asset finance companies, loan companies and investment companies are merged into a new category called NBFC Investment and Credit Company. Now let us see each of the following. Asset finance companies. This focuses on financing of physical assets such as automobiles, tractors, generator sets, etc. Next, investment company. Its principal business is acquisition of securities. Next, loan company. Its principal business is the providing of finance, but it should not include an asset finance company. Now let us see a question on this. NBFCs raise their resources from which of the following? Loans from banks, issuance of bonds in financial markets, external commercial borrowings and mutual funds. The answer is all of the above because NBFC raise funds from two sources, either through loans from banks or through issuance of securities. So the answer is all of the above. Thank you.